Good afternoon, everybody. Hopefully this is working. I am checking out my screen just to make sure it is working. Waiting for a few more attendees to join us. Hopefully you can all hear me okay. So if we can just give it another minute, that would be terrific. Hope you're all doing well today. And yes, note my cup. Anyhow, okay, I think I'm going to go ahead and get started, and I'm going to share my screen with you. There we go. Okay, I'm going to go ahead and get started. Welcome. Thank you for joining me at Secure Act 2.0, What You Need to Know. My name's Deborah Kelly, Deb Kelly. I'm an FA, financial advisor, and a certified financial planner, CFP, with Potomac Financial Group. And some of you who are attending right now work with my associate, another financial planner, financial advisor within the office, Chris Heels. So welcome to all of you. I've allowed for questions during this, but I'm really not terribly proficient at the Zoom webinar presentations. Zoom, my goodness, since 2020, I should be an expert right by now, but the webinar side of it is a little more challenging for me. So if I'm not able to get to any questions at the end of the webinar, please know that I will get back to you. Chris will get back to you. One of us will get back to you and try to answer any questions that you may have. So Secure Act 2.0. Secure Act stands for Setting Every Community Up for Retirement Enhancement. And Secure Act 1.0 was passed in late 2019, December of 19, went into effect January of 2020. Secure Act 1.0 changed a number of regulations related to retirement plans, many of which I'm going to mention in this presentation, many of them that have been updated or enhanced since Secure Act 1.0. Secure Act 2.0 was only recently passed in conjunction with the Treasury Department and the IRS that came up with the rules, and then it was passed, as you likely know, in late December 2022, and it included further changes and enhancements to retirement plans. Again, many of them I'm going to go through here, not all of them. If you have questions, again, feel free to reach out to us, but I'm just going to address the most pertinent ones that at least I feel that are most pertinent to clients. So let's start with one of the biggest ones, which is changing the age of RMDs. I think it's perhaps the most significant change. And RMD is required minimum distributions, and there is an actual required beginning date. And that is the year that you must begin taking distributions on an annual basis from your retirement plans, whether they're workplace retirement plans or employer-sponsored or IRAs. So from 1974, when our IRAs were first created, until 2020, when Secure Act 1.0 came into effect, the RMD age, the beginning age, was 70 and a half. So you were required to take your first distribution in the year you turned 70 and a half. Of course, you could take distributions before that if you wanted to, but you weren't required to until you hit age 70 and a half. Secure Act 1.0 raised that age from 70 and a half to age 72. So if you turned 72 last year, 2022, you should have begun taking your RMDs last year. With Secure Act 2.0, the RMD, the first year that you're required to take, has been pushed back by another year to age 73. So what that means, if you turn 72 this year, you don't have to start taking distributions because it is now 73 for a beginning age, excuse me. So you may delay your RMD until 2024 when you turn 73. That's when you're going to be required, when you turn 73 in 2024. You're even allowed to push back your first RMD to April 1st of 2025. So the IRS allows you to delay your very first RMD year. So the year that you turn now, it's going to be 73. The year that you turn 73, you can take it that year, the required amount, or you can delay it, push it into the next year, but you must take it by April 1st of that year. What you need to be aware of, if you push it into the next year, so you take it by April 1st of 2025, this is those turning 73 next year, you have to be aware that you're required to take 2 RMDs in 2025. So one would be—
I can hear it.
I don't know who's speaking, but anyhow, sorry about that. If you can hear somebody in the background, I don't know who that is. It's somebody coming through my speaker. Anyhow, you would have to take 2 in 2025. The first one, which would be by April 1st, 2025, that's your delayed first RMD. And then the second RMD, the one for that year, would have to be taken no later than December 31st of 2025. Starting in 2033, however, the beginning age for RMDs is going up to age 75. So it's being pushed back even further. Here, I just have a little chart for you so you can see the year you're born. If you were born prior to 1948, your RMD age was 70 and a half. 1948 to 50, 72. From 1951 through 1957, your RMD age is 73. And for those of you born 1958 and later, your beginning RMD age is 75. So one big benefit in this delay of RMDs is it may expand your window for possible Roth IRA conversions. So instead of having to take your distribution at 72 or 73, you get to wait until 75. That's adding a few years that you may want to convert your retirement account, your IRA, your 401k, whatever it might be, to a Roth version. And it's a Roth conversion is a strategy used to change tax-deferred retirement savings, again, IRA, 401k, TSP, into a Roth IRA savings account. Roth, you get to enjoy tax-free withdrawals down the road, and it is not subject to RMDs. So this is known as a backdoor Roth. So again, I want to point out, employer-sponsored, this is going to be for something I'm going to talk about in just a moment. Employer-sponsored accounts or retirement plans include 401ks, 403bs, TSPs, 457. So that's all the lingo. Those are all very similar. They're employer-sponsored or workplace plans. An IRA, on the other hand, isn't related to the workplace, and you can contribute it either directly with some restrictions, some contribution limits, or you can roll over an employer-sponsored, your 401k, your TSP, into an IRA. And an IRA is typically held at a place like Raymond James, and you have somebody managing it, a financial advisor like me, or Chris, or whomever else. Okay, so the IRS doesn't mess around when it comes to RMDs, and they've always imposed very, very stiff penalties if you forget or neglect to take your RMD in a given year. So once you hit that RMD age, don't forget to take those RMDs because you will be penalized. Before Secure Act 2.0, if you didn't take your RMD by December 31st in a given year, the IRS charged you a penalty of 50% of the amount that you didn't take. This is known as an excise tax. So imagine you've got a $10,000 RMD, amount that you're supposed to take, and you don't take it. Now the IRS is going to go back, make you take that $10,000, and then they're going to give you a penalty or hit you with a penalty of $5,000. So that $5,000 penalty is on top of the income taxes that you're going to have to pay on that $10,000 distribution. So it's a very, very, very stiff penalty. Up until Secure Act, it was 50% of what you were supposed to take. Beginning this year, due to Secure Act 2.0, the penalty for missing an RMD in a given year is dropped to 25% from the former 50%. still a stiff penalty. 25% is a lot of money. So instead of 10,000, you're going to pay a penalty of 2,500 on that example a minute ago. This is where it gets a little bit murky. If the RMD that was missed is taken in a timely manner and you file an updated tax return, the penalty will be reduced to 10%. The problem is it's unclear what in a timely manner means. So the IRS is going to need to provide further clarification on that. So not knowing what in a timely manner is, it's just so extremely important that you make sure you take your RMD every year. Chris will make sure he works with you in doing so. I always make sure that I have RMDs satisfied for all of my clients. So it's crucial. Avoid that penalty. Makes no sense to pay it. And then there are some R&Ds from inherited IRAs. This has been a little bit confusing, and this is about a frustrating, at least in my opinion, as an advisor, a frustrating change that the IRS has made, or the legislators have made, with regards to inherited IRAs. Before Secure Act 1.0, when a beneficiary inherited an IRA, they were required to take distributions, or RMDs, each year based on their own life expectancy. And those are calculated from or drawn from a single life table the IRS puts out. So imagine the original owner is 80 years old. Their life expectancy, according to the life tables, is 20.2 years. So they, in effect, would be taking it over 20.2 year period. So 80 for the next 20.2 years, they're taking distributions, RMDs. Let's say they pass away and you're 45 and you inherit it. Before Secure Act 1.0, you would start taking RMDs based on your own life expectancy. According to those single life tables, that's 41 years you're expected to live. You're supposed to live to 86 if you're 45. You would have had 41 years to stretch those RMDs out, 41-year period to take the distributions. You can take them sooner, just like you can take sooner from an IRA before your RMD age, but you're not required to. So Secure Act 1.0 eliminated RMDs from inherited IRAs. And basically, they eliminated the stretch of those IRAs, the beneficiary IRAs. So they're not based on the beneficiary's lifetime anymore. Now, instead, the new regulation required that the entire inherited IRA must be fully distributed within 10 years. So somebody passes away, that 80-year-old passes away. Over the next 10 years, that inherited IRA that they're leaving to their beneficiaries must be fully distributed. With Secure Act 1.0, it could be distributed any way the beneficiary chose. You could take a lump sum initially, you could take some each year, any year you wanted, as long as at the end of 10 years, you took a full distribution. The IRS just doesn't want to wait those full 41 years to receive tax payments. Now they provided a little more clarification. Apparently, when they came up with Secure Act 1.0, the intention was that if you inherited an IRA and the original owner was already at RMD age, so was already 72 years old or older and taking distributions, they wanted you to have to take RMDs only in that situation if the previous owner, the original owner, was already taking distributions. They did not make it clear. So everybody just thought it was that 10-year distribution period at whatever intervals you wanted. Now, however, they've provided some clarification, and this only pertains to those when the original owner was taking distributions before their death. Now, RMDs are required every year for an inherited IRA under those situations. The original owner was taking distributions, RMDs. Now the beneficiaries must take RMDs over that 10-year period. So that 10-year period is still in play. But now, years 1 through 9, they have RMDs. Then that last year, the 10th year, they just have to take the remaining amount. Their original intent, again, was to have this start with Secure Act 1.0, it wasn't clear. So they have decided to waive those RMDs that were not taken in 21 and 22 for those who inherited an IRA from an older owner. If the original owner had not started taking distributions before death, though, the distributions each year by the beneficiary go by those same rules that we've been doing since 2020. Just make sure it's fully distributed by the end of 10 years. Doesn't matter how often, if you take every year or what have you, you just need to make sure at the end of 10 years, you fully distribute the entire inherited IRA. Another feature or rule regulation that is coming out by through Secure Act 2.0 is automatic enrollment into 401ks by employers. The IRS is trying to encourage people to save for retirement, especially since most companies no longer have a pension, and they don't want people relying on Social Security benefits. They certainly don't want to have everybody hitting Medicaid because they don't have enough saved for retirement. So they're really trying to encourage saving in employer-sponsored retirement plans. So they've made some changes to entice employees to contribute to those plans. Remember, those workplace or employer-sponsored plans include the 401ks, 403bs, 457, TSP if you're a federal employee. So again, many Americans don't bother participating. They may work for an employer that offers a plan, but they don't bother participating. So starting in 2025, when companies set up a 401k, 403b, TSP for new employees, they're going to be required to automatically enroll that new employee at a 3% contribution rate, automatic. And then that is automatically increasing by 1% each year until it gets to 10%. The employees, however, may opt out of those contributions if they so desire. But the thought is, if the employer goes ahead and starts that initial 3%, the employees won't bother opting out. Hopefully they won't opt out. They'll stay in at 3%. It'll go up each year. Maybe they won't even notice. Who knows? But the goal is to get as many employees to contribute to a plan as possible. Again, let's maximize what we can contribute into a retirement plan. They've increased the retirement plan contribution limits, which they have done in the past as well. So the contribution limit for employees who participate in those workplace plans, again, is increasing to $22,500 this year. It's up from $20,500 in 2022. The limit on annual contributions, to a traditional IRA and or a Roth IRA, those have increased to $6,500, up from $6,000. And those contributions, this in a non-workplace plan, are subject to some income limits, and it's based on your adjusted gross income. So if you are married and your income, your adjusted gross is between $218,000 and $228,000, that's your phase out. For single filers, $138,000 to $153,000. What this means is, say we're looking at single filers. If your adjusted gross income, your AGI, is $138,000 or less, you can contribute the full $6,500. If it's above $153,000, you're not eligible to contribute at all. If, however, you're between the two, you're between $138,000 and $153,000, your contribution is prorated. So you'll be able to contribute a portion of the $6,500. Carrying along with this, there are some increased catch-up provisions. Catch-up provisions are offered to employees or people who are 50 and older. So they're eligible, they're closer to retirement age. So a little bit of a catch-up for them as far as contributing to the retirement account. For workplace plans, and this is workplace only, the TSP, 457, 401k, et cetera, the catch-up contribution in 2023 has gone up to $7,500 from $6,500, again, for those 50 and older. In 2025, individuals age 60 to 63, they're going to be even closer to retirement, so they're going to be able to save even more towards that retirement, and the catch-up contributions for them are going up to $10,000 per year. Again, workplace plan only. Those catch-up contributions are also going to be indexed to inflation, cost of living increase, kind of like your Social Security benefit. You've got a COLA, pensions, so they're inflation adjusted. Those catch-up contributions moving forward are going to be indexed to inflation. They have not been so in the past. The catch-up contributions for IRAs and Roth IRAs, they're going to remain at $1,000. No cost of living increase for them, no index to inflation. And again, those are the ones that you can contribute $6,500. So if you're 50 and older, you can contribute $7,500. Let's see here. Okay, there is a caveat to this. If you earn more than $145,000 in the prior calendar year, and you make catch-up contributions, again, 50 and older, and you made more than $145,000, they must be after-tax dollars, meaning you must pay taxes on those contributions now. They will be put into a Roth account, again, in those after-tax dollars. And then moving forward, they're tax exempt. All the growth would be tax exempt, just like any other Roth IRA. But again, if you made 145 or more the prior year, the contributions, the catch-up must go in a Roth account. It cannot go just in your regular 401k. It would have to go into a Roth 401k. This is a really nice benefit that they have added in Secure Act 2.0 for those people stuck with student loan debt. And they've got an employer who happens to offer contribution matching. Most companies, not all, do offer to match contributions. And with that, an employer will match up to a certain percentage of an employee's contribution into a plan. It's basically free money. So let's say a match is 3%. The employee contributes 3% of his or her salary to a retirement plan. That company will match it and will contribute 3% as well. It's like a 3% bonus each year. Under the same matching scenario, let's say the employee contributes 10% of his or her salary. The company is still only going to match 3%. So it's a matching program to a certain point. Starting next year, employers are going to be allowed to match student loan payments made by the employees. So instead of it having to be a contribution to the employee's retirement plan, if they make a contribution, or excuse me, if they make a payment on a student loan, the employer will be able to match that in the employee's retirement account. Because a lot of students kind of have to pick and choose. Well, maybe they can't pick and choose. They can't avoid paying the student loan back, but maybe because they're paying that student loan, they can't afford to contribute to their 401k, their TSP. Well, now the employer is going to be able to do the matching contribution for them. That's never been allowed before. It's a really nice perk for somebody who has student loan debt. Talking more about student loan debt. A 529, there's a new feature that allows for a rollover of a 529 plan into a Roth IRA. This is really key. In the past, a lot of families have hesitated opening up a 529, fully funding it. Fear was that, what if I put too much money into it? What if the child doesn't go to college? What if they get a scholarship, an academic scholarship, an athletic scholarship, and they don't need a 529? They're not going to use it. Well, up until now, it would always be subject to, it's always subject to taxes. Any growth would then be subject to taxes. And there was a 10% penalty if you didn't use it towards higher education, or since Secure Act 1.0, towards private kindergarten through grades 12. Secure Act 1.0 made it so that instead of only using it for higher education, you could use up to $10,000 per year in a 529 plan towards private kindergarten through grade 12. But if you didn't use it for that or higher education, again, the gross is going to be subject to taxes, and there's a 10% penalty. Now, however, there's an option. Starting in 2024, any assets left in a 529 plan can be rolled into a Roth IRA for that 529 plan's beneficiary, that brilliant child of yours who got a scholarship, or the child who just said, I don't want to go to college, whatever it might be. You can roll that into a Roth IRA for that beneficiary. It's basically a backdoor Roth contribution. Never available before. It's a really fantastic feature of Secure Act 2.0. Couple of rules though. The 529 plan must be at least 15 years old. So you're going to want to start it when a child is young. And then there's a maximum lifetime limit to what you can put into this or roll into the Roth IRA of $35,000. So if you've overfunded a 529 plan by $35,000, you can roll that into a Roth IRA for the beneficiary after 15 years. I mentioned earlier employer matching contributions. In the past, employers were only offered tax-deferred retirement plans. So years ago, employers didn't have Roth 401ks, Roth TSPs, after-tax plans. It was always pre-tax, meaning you didn't pay taxes on it when you made the contribution. So it was always just a 401k or a TSP. If an employee made his or her contribution, well, then a few years back, employers started offering Roth versions of their employer-sponsored plans, their workplace plans. So there are now Roth TSP versions. There are Roth 401ks. If an employee makes a contribution to an after-tax Roth plan, a Roth 401k, in the past, the employer matching, that 3% example I had earlier, had to go into the tax-deferred or a pre-tax plan. It would have had to gone into the 401k. So an employee would have a Roth 401k, after-tax dollars for their portion, and then the matching done by the company always had to go into a regular tax-deferred 401k. So the employer's portion always had to go into the more traditional version. Now, however, employees are going to be able to provide employees the option of receiving those vested contributions, the matching contributions, into a Roth account. So the employee can have a Roth 401k, a Roth TSP for their own contributions. And again, they've paid taxes on that. It's after-tax dollars that will grow, never pay any taxes again. And they will also have their employer contribute to that same Roth 401k. You don't have to have the two versions anymore. It can all be after-tax dollars. Wonderful thing about that, especially the younger you are, it's all going to grow tax-free. All of the earnings are tax-free. You'll never pay taxes on it again. This is going to play into that same, the Roth account. So I was talking about the Roth 401k, Roth TSP. In the past, RMDs that are still in an employer-sponsored Roth plan. So if you hit age, whatever it may be, 73, and you had left it in a Roth 401k, you would have had to start taking RMDs, even though it's a Roth version of your employer-sponsored account. So at age 72, which is now 73, you would have to take RMDs each year from your Roth 401k, TSP, what have you. Beginning in 2024, however, RMDs are no longer going to be required in those accounts. This is the same thing that happens if you were to convert, say you have a 401k or a TSP, you retire, you convert it into an IRA, and you do a backdoor conversion or a Roth conversion into a Roth. So all your money's in a Roth, but it is no longer with your employer. then you've never had to take RMDs because Roth IRAs are not subject to RMDs. Now, moving forward, starting next year, workplace sponsored Roth accounts will no longer be subject to RMDs either. Another benefit that's going to be available or can be offered by an employer, and these are all perks to get these employees to start saving, has to do with emergency savings, this one. So employers may, though not required, can offer a Roth emergency savings account for employees. So participants could contribute up to $2,500 annually, unless a company sets it at a lower amount, can't be higher than $2,500. And they can set it up so there's a designated Roth emergency savings account. So that would be separate from your Roth 401k or TSP. And the first 4 withdrawals in a year would be tax and penalty free. So normally there are rules with regards to taking distributions out of a Roth, age limits 59 and a half to make them tax-free, penalty-free. But with this emergency Roth savings account, the penalties are avoided on 4 withdrawals each year. Those plans, depending on the employer, may also be eligible for an employer match, which is pretty amazing. You could really rack up those numbers pretty quickly, and you're storing it in that emergency savings account. So this is $2,500 annually. If you don't use it the first year and you add the full amount both years, the next year you've got $5,000 available for you to use for an emergency savings. So it's just really encouraging participants to start saving for short term. So your typical, your 401k or your Roth 401k, your TSP, those are for the long-term savings. This is for your short-term and your unexpected expenses. All of this is coming from Secure Act 2.0. Now, I mentioned there are other features to Secure Act 2.0 that I'm not necessarily going to cover here. If you want, you can reach out to me if you have any questions, if you hear about any. But I wanted to point out a few changes to income tax numbers, some of the numbers with regards to income tax numbers. Let's see here. First, the marginal tax rate brackets have been updated, and they are every year. Let's just go with the 22% tax bracket here. And these are marginal tax brackets. So if your adjusted gross income is within these brackets, you're going to pay 22% on the amount in between here. So if you are single and you are or married filing separately, in 2022, the 22% bracket ran from, let me see. Oh, we don't even have it here. So in 2020, married couples. For married couples, the number for 22% tax bracket in 2022 was $83,550 to $178,149. Now you can see those have gone up somewhat. So the top end of it was $178,149. This year it's going to be $190,750. And then going with the single or married filing separately, last year the numbers were $41,775 to $89,074. You can see those numbers have gone up. The high end of the 22% bracket is over $95,000 now. A couple more adjustments this year. The standard deduction for a married filing jointly is going up. 2022, it was $25,900. 2023, it's up to $27,700. And then you get your single numbers here or married filing separately, going from $12,950 up to $13,850 in 2023. Again, this is the standard deduction if you do not itemize. Itemize is completely different. That stays the same. And then also in 2023, the gift tax annual exclusion is going up. 2022 is at $16,000. 2023 is at $17,000. Again, this is per person. If you want to gift to your son and his wife, you can gift them $17,000 each. So that is per person there. Well, that pretty much wraps it up for me. I hope you found this useful. I hope you got a couple of tidbits from it. If you have any questions, again, please reach out to me. If you would like me or Chris, or even your tax preparer, I don't know if they have the tools. If you want us to run something like the Roth conversion calculations, we're happy to do it. Chris and I are happy to do it for you. We have a tool through goal planning and monitoring that will actually do the calculations to see what you would save or your beneficiaries would save by doing these Roth conversions. I will also have a replay available. If anybody is interested in receiving that, I can send that out to you. Otherwise, thank you for joining me, and I hope you enjoy the rest of your afternoon. And sorry about all the stumbling. Have a great day. Thanks so much. Bye.